Hey soldiers, another one bites the dust. By now you know First Republic Bank has been seized by the federal government. Its assets will be sold at fire sale prices. Now listen, when we started this channel, it was with the intent of looking at the wealthy, individuals and organizations, and adopting behaviors that they'd used or are using to create wealth. We certainly have that opportunity here. Let's figure out what happened to First Republic, because there's a lesson there. Jamie Dimon, in the midst of SVB's failure, in the midst of Signature and now First Republic, Jamie Dimon, CEO of JP Morgan, is saying the system is very strong. Why is he saying that? We'll examine it. Now, we're going to talk about how to prosper, the lessons that this offers, and the opportunities that this offers. Okay, so we're not just going to talk about the failure of the bank. We're going to look at it from a standpoint of us making money. All right. And then, guys, we got to ask ourselves, what questions do we need to have top of mind when looking at our bank? What questions do we ask the management of banks that we may have deposits with in order to make sure that bank is fit for the long run? Okay. So let's just jump right into it with what happened first to First Republic. All right, it failed to reckon with the impact of rising interest rates. Essentially, what happened is they had a strategy that was going to offer its customer base a hometown feel, okay, small bank feel. And they were going to be, not as aggressive on the interest rates, but their customers were going to get special treatment. Like, in this Wall Street Journal article, there's a gentleman who was traveling overseas and they were making special dispensations for him to have enough money in the currencies of the countries he was traveling in. Really, white glove service. And so people were, people were willing to say, okay, yeah, sure, I could get better interest rates over here, slightly better, but the service I'm getting over here really makes up for what I'm missing in interest rates, okay? So that was a big part of their strategy. But interest rates started to rise. And when that happened, it had a material effect on them not being able to attract new deposits. And the deposits that they had started to exit because they could get better returns elsewhere. You can only offer so much white glove service before people then take a look at the returns and say, hey, wait a minute, I'm really missing out on some money here. And so money started to migrate out of the door. In fact, this bank lost $100 billion in a matter of days, right? Back during the March period. Now, this was after SVB and Signature had imploded. The other thing you got to keep in mind is they realized, First Republic realized that they were having difficulties prior to the March fallout with SVB and Signature. So they knew that they were having a little issue because they were in a rising interest rate market. So that's essentially what happened. Now, JP Morgan's CEO, Jamie Dimon, came out on a call and he said that with regard to the industry, look, the system is very, very strong, very, very sound, very, very sound. That is what he said. And people are wondering, well, why would you say this after the second largest bank has gone belly up? Well, a few reasons. Number one, JP Morgan is going to be buying a lot of those assets. And what assets am I talking about? Well, loans, for example. So JP Morgan can go in, bid for those loans at less than the cost, and get that revenue flowing in. Okay? So, great deal for them. And that is where our first lesson lies. Don't hate the player, hate the game. Okay? So what we want to be able to do, what we want to put ourselves in a position to do, is take these rapidly declining in value Federal Reserve notes and turn them into something that is a true asset. The dollar is losing value, it's losing prestige. Okay, that's no secret. We cover that all the time. But our task as soldiers of finance is to take these pieces of paper and turn them into something more, an asset that produces income, okay, in some cases. And when you look at the stock of JP Morgan, they certainly do have a dividend, so there's some income there. And over time, they have certainly appreciated. Now, in full disclosure, we did the video a while back, a week or two ago, telling you how I had divested myself or sold all of my JP Morgan stock. Why? It wasn't a financial decision. It was a principled stance. Jamie Dimon came out and he started talking about the fact that he's an advocate for taking people's property, for declaring eminent domain in conjunction with the government for the purposes of cleaning up the environment. Now, we all know he's not talking about any property he owns, okay? He's talking about the property of people who do not have the resources to engage in protracted legal battles, all right, to maintain their property. So he's talking about me and you. So when I looked at that, I said, you know what? I don't like that. And there are other assets. JP Morgan is not the only asset that I can have my money in. And I promptly sold and placed the money elsewhere. Okay. And I've been with them, a shareholder, for a long, long time and did quite well with them. Okay. So no regrets there. After another massive bank failure and taxpayer-funded bailout, JP Morgan CEO Jamie Dimon told listeners to an investor call this morning that the system is very, very sound. That was a quote. Quote, the system is very, very sound. All right, now, when he's talking about the system, what exactly is he talking about? Well, he goes on to say, we need large, successful banks in the largest economy. This is nothing like 08 or 09. So he's advocating for the big banks, and he's saying that wherever he can find, an opportunity to buy low, okay, in the case of First Republic's assets, for example, he's going to do that. So what has he done? He has taken some worthless Federal Reserve notes and turned them into an asset. Okay, a larger asset for the bank and its share owners. Now, that's the lesson that we really need to take out of everything that's going on. And some people say, well, I don't have the money to go out there and buy stocks. Have you seen the price of groceries? And this is why I'm holding up $1. We did the review of Wealthfront a few days ago. And Wealthfront, of all of the services that they offer, one is fractional investing, where you can actually get into a stock for $1. So after you've done your due diligence and you've been able to identify a stock that has good fundamentals and meets your expectations for performance, you can actually get in your pocket. Now, everybody has one of these. Because what does it do these days? I gave you the analogy about what this used to purchase for me at the corner store when I was young, a young buck, okay? Doesn't do nearly any of that anymore, okay? You got to have like 5 of these now to do what one of these did at the corner store back when I was young. So why not take this and do what Jamie Dimon did and turn it into an asset? And look, Wealthfront is not the only service that allows you to purchase fractional shares. It is the only one that I have seen that allows you to do it with as little as $1, okay, to get you in the game. The rest I've seen start at $5. Now, I always offer this caution when we're talking about fractional investing. Don't strive for the minimum. Yeah, they'll let you invest with $1, but your purpose there is to try to get more money into the game, get more of these failing Federal Reserve notes into a position where they are actually working for you, okay, and not just sitting around losing money. All right, so the last thing that I want to cover here is very important because I've talked to you guys at length about getting with your bank management and, asking them questions about, hey, what's going on? Is my money safe here? Is this bank safe? What would happen to my loan here or my credit card if you guys went defunct? There's one question that you can ask that is all important. All of the banks that have had some problems have had one specific thing in common, and they've had a high proportion of uninsured deposits. So when we look, we got a list here we're going to take a look at, and I'm actually going to link to this in the comment section so you can take a look and examine and see whether or not your bank is on here. Now, even if your bank is not on here, because this is like the top 20, all right, your bank might be 21, so you don't want to just look at this list, say, oh, my bank's not on it, and then just, sit back and relax. So the red dots on this list indicate banks that have been acquired or outright failed. And one of them, this list the First Republic issue is so fresh, they're not on here yet. But we have, of course, Silicon Valley Bank, Signature Bank, MUFG Union Bank, and Bank of the West. There's some other interesting banks on here. And again, these are banks that have a very high proportion of uninsured deposits. And we've seen that's been a commonality. All of the banks are going to be in the same position with the interest rates that the Fed controls. Now, what interest rate they offer their clientele is, that's going to be variable, but you can rest assured that depositors are always going to be looking for the highest return. So if there's a big spread between what that bank is offering in terms of its APY and what they can get elsewhere, then that bank may be vulnerable. So some of the other names on this list include JP Morgan, U.S. Bank. Now, one of the soldiers contacted me and said that they were hearing that U.S. Bank was maybe, something that we should pay close attention to here. And I heard those same kind of rumblings about First Republic, about 3 weeks ago. Okay. So if your bank is on the list, and for those of you who, this is a small list, again, I'm going to link to it, but we've got some big ones on here. JP Morgan, we've got Fifth Third, Goldman Sachs, okay, Bank of America. Now that's a very big consumer-facing bank. JP Morgan is too, because remember they own Chase, all right? Goldman Sachs has the Marcus High Yield Savings Account online. And they're doing business. Here's another thing. Not JP Morgan, Goldman Sachs, they're doing business and undergirding Apple's new high yield savings account. Okay. So this is an intricate web that we've got going on here. So there's nothing wrong with you calling your bank and saying, listen, I need somebody to tell me, I saw my bank on this list and I need somebody to talk to me about, how you guys feel about the strength of the bank in relation to these uninsured deposits that have been the common characteristics of these other banks that have gone bust here lately. Okay. And again, even if your bank's not on this list, you still might want to call them because, again, you don't want to be the one that's, oh, I'm good, I'm safe, my bank's not on the list. And your bank would have been on the list if they'd just gone one level deeper. So that's what we got. Listen, I want you guys to be clear about something. Yeah, there's a lot of turmoil, turbulence, and volatility in the world today. Our job is to take a look at that and figure out where the opportunities are. Because in chaos, there is always opportunity. All right. So some of these headlines might seem a little scary. Okay. But just remember, there are tons of opportunities here for those who are willing to sit back and examine the situation objectively with a cool head. Okay. And that's what we try to do here. All right. So what I want you to do is I want you to go ahead and take a look at this video. The Fed, Goldman Sachs, and Wells Fargo are warning that we could see a recession here. okay, later on in the year 2023. Again, that would make asset prices, very affordable. Let me give you an example. Real estate, okay? Now, we're in an environment where we've got rising interest rates. A lot of people are complaining about that from the standpoint of buying a home or an investment property. So we got rising interest rates on the one hand. On the other hand, we got what? The threat of a recession. Now, where's the opportunity in that? Those two factors should put pressure on people who are selling properties and have them in a position where they're lowering their prices in order to move that property. But Tyrone, the interest rates, what about them? The interest rate is actually the flexible variable in this whole metric, okay? At some point, it is possible that you would be able to refinance into a lower rate if and when rates start to moderate and come down. The inflexible variable here would be the price of the property, okay? That's not going to change. So wouldn't it behoove you to say, it may behoove you, I think this will work for me, you got to decide for yourself, okay, I can get this property for less. Yeah, the interest rate's going to be higher, but over time, I can maybe bring that down and make this more profitable. Now, if you're buying an income-producing property, like to rent it out or something like that, then of course you got to do some math on that. Make sure it's profitable. I used to hear people say, "Oh, I'm going to lose money, but it's going to be a tax write-off." Come on, man. No, the goal is to make money. Warren Buffett can play that game, but most of the time with an income-producing property, you don't want to get that esoteric with it. You just want to go ahead and make straight money. Okay. Then when the rates come down, boom. So there's an example of how we can use these opportunities. All right, guys. So go ahead, look at that video. Talks about how these financial institutions feel about the prospects for the coming months. Guys, I'll talk to you soon.